Okay, so welcome back. We are starting with the new chapter, chapter 10, strategic analysis of operating income. So far we have completed part A of your syllabus, which is the most voluminous or most important part. Of course, I am not saying that this part B is not important. It is also equally important. But if you see the mark distribution, you have a mark distribution of 40% from part A, then 40% from part B, then you have part C or case study, which covers for 20%. So altogether 100%. This is how the mark is being distributed in your syllabus. Okay. Now, the case study of 20% marks will generally be from part A alone. Okay, you have learned chapters 1 to chapters 4. Okay, so from that topics only, generally you will get any case study. Of course, we have chapter 8, and chapter 8 could also be a area from where you can get some case studies, but full-fledged 20 marks case study, generally it can be asked only from the concepts that is taught in chapter 1 to chapter 4. Okay, that is why the weightage of part A is not just 40%, it will be 40 plus 20, that is 60%. And whenever we see the mark distribution in the previous year question papers, we could find that the mark weightage for these topics could be as high as 70% in certain papers. Okay, so part A is pretty important, and we have covered almost all the topics except for I have left certain few case studies in that, and also I have left learning curve. Okay, learning curve problems also, because learning curve has to be taken separately, so I will have to come to that separately. Okay, so except for this learning curve topic, I have covered all the topics, and there is one chapter left out, that is chapter 5, that is costing for specific sectors. That is nothing actually, it is only 1 or 2 pages theory, purely theory, and there is now relevance for that particular topic from exam perspective also, but still we will cover that topic also. Okay, so that I have left, I am not leaving that particular topic, but other than that, we have covered chapter 1, chapter 2, chapter 3, chapter 4, then chapter 6 and chapter 7. Okay, so up to chapter 7 we have completed. Now, what all is left out? We have chapter 8. Chapter 8 is purely a theory topic. Okay, but I would say it is important also, because you have a lot of evaluation methods in that, and few small problems from that evaluation could also be asked. So chapter 8 is that. Then chapter 9 is divisional transfer pricing. Divisional transfer pricing. It is also an important topic. Okay, then 10 is what we are going to see now, that is strategic analysis of operating income. It is also an important topic only, but the compared to the part A topics, its effect is less. Okay, then chapter 11 is budgetary control. Then chapter 12, yes, chapter 12 is standard costing. Okay, now if you see these topics, by today and tomorrow I plan to complete chapter 10 and 11. That is, chapter 10 is strategic analysis of operating income, and chapter 11 is budgetary control. Budgetary control is, as far as your CA final is concerned, it is a very small topic, because the preliminary functional budgets and flexible budget, those things we have already learned in your IPCC. So just continuation of that, and you have certain new concepts in budgetary control. So that is what I am planning for today and tomorrow in these sessions. Then what will be left is chapter 8, 9 and 12, and standard costing chapter 12. I will take around half day for this, half to maybe 3/4 of a day will be required for standard costing. Then divisional transfer pricing and this theory, and divisional transfer pricing also we will have to spend around 1 day. And regarding this theory, I will have to take a separate session on this, which will be after initial our class plan was to complete the topics by October first week. October 4th will be Sunday. So after that, I may require 1 more day for completing this theory topic, chapter 8. and we will have certain case studies and previous exam questions and RTP questions. Okay, that we will take separately, and I plan to take each question paper in every week, so that it will help you for your exams also. So I will inform you the timing, okay, and at that particular time, maybe 3 to 4 hours every week, maybe on holidays or whatever, I will inform you the timing later. We will solve the question papers in like we do it for the exams. Okay, so that will give you practice, and also for the case studies, I will record those lessons, and I will send you the case studies which is not that much important, and the remaining case studies we will work out in the class itself. Okay, so that is how I am planning, and in total I will be covering almost all the topics. I have not left out any. I am not planning to leave any topics as such. We will be covering each and every topic, and it will be a conclusive course covering all the topics which are required for your exams also. Okay, so right now we'll start with chapter 10. You can write the heading: Strategic Analysis of Operating Income. And this particular chapter starts or is the beginning of part B. Okay, if you see, the name of our subject was what? Strategic Cost Management and Performance Evaluation. Am I right? Performance Evaluation. Part A was all about strategic cost management. That is what we saw till the previous session. Strategic cost management. How to manage your cost. We saw various techniques, etc. etc. Now, it is not enough that you have certain strategies for managing your cost. Once you have strategies, you have to evaluate the impact of those strategies. If you are implementing Six Sigma, or if you are implementing TQM for managing your cost as a strategy, then after that particular period is over, you will have to evaluate how this strategy worked out on your cost as well as your revenue. That part is what is covered under performance evaluation, and part B is all about performance evaluation. Okay, so in part B we are going to see evaluation of the strategies employed for the cost management. Okay, that is what is known as performance evaluation. Okay, so part B is all about performance evaluation. And what is it? What is this performance evaluation? It is evaluation of the impact of various strategies adopted by the entity. For what? Why did you implement these strategies? For management of cost. Okay, so strategic cost management. You are managing your cost using various strategies. Okay, and what is the impact of those strategies adopted by your entity? That is what is covered in performance evaluation. Okay, now this particular chapter, it can be divided into 3 parts. Okay, so chapter 10, I'm dividing into 3. One is, first part is profitability analysis. Profitability analysis. Okay, the second part is all about activity based management, or shortly known as ABM. Okay, and the third part is activity based budgeting. activity based budgeting of ABB. Okay. Now, what is profitability? Profitability is nothing but the profit earned by an entity or a division or a unit or branch or whatever. So, profitability analysis means analysis of the profits earned by the an entity or an firm or whatever. Okay. So, this is basically analysis of profitability. Now, when you say profitability in costing, we refer to operating income. Okay. What is operating income? Operating income is nothing but operating revenue less operating expenses. Okay, let me write it as O5. Now, why operating income and operating expenses alone? Why don't we consider the non-operating income? It's a crucial question, right? Non-operating income. If an entity is earning some non-operating income, why don't you consider that for your analysis? It is because the objective of any costing tool or costing method or costing technique is to assist an entity in its operations. So, the impact of any costing tool or costing technique or costing method will be seen only in operating income and operating expense, not on non-operating income or non-operating expense, because an entity is not there to earn any non-operating income or to incur any non-operating cost. Non-operating incomes and costs are those costs which are originating without any specific activity or without any specific effort from the entity. Because, say, for example, interest on the investments made. An entity had some surplus fund which they invested in bank, from which they are earning interest. Can you implement any costing for that? No. You can't implement any costing technique or costing management for that particular non-operating activity unless that becomes your operation. Of course, if that investment is your operation, main objective or main operation, then you can apply costing techniques to that. Unless in that situation, except in that situation, you can't apply any costing technique or costing method for such incomes. Is it clear? So, while doing the profitability analysis, we are not concerned about non-operating income or non-operating expenses. Or rather, we are concerned only about the operating income. And operating income is nothing but operating revenue minus operating expense. Okay, so that is the first concept which you need to understand. Then coming to next, activity-based management. What do you mean by activity-based management? It means in chapter 4, if you remember, we learned about value chain analysis. We learned about what you call as the cost driver analysis, those things. What was that? The entire concept of modern costing revolves around the fact that the cost is incurred not on account of the input used or output used. It is based on the activities which are consumed for getting the or for converting the input to the output. So conversion of input to output is only a process, and that process is led by or that process is controlled by various activities. So if you want to control the cost of input and output, what you have to do, and the conversion of input to output, you have to concentrate on the various activities which constitutes that conversion or which enables that conversion. Okay, that is the concept of the modern costing. So in modern costing, we are out of your fundamental absorption costing where you were planning your cost of material, cost of labor, etc., etc. All those things are gone. Now you have only activities. You have various activities. Yes, this manufacturing is an activity. Manufacturing activity has various sub activities, and these sub activities has various subtasks. Like that, we are breaking down the entire process into various activities, and we are identifying each activity with a cost driver. Am I right? And we are watching how much cost drivers, how much volume of these cost drivers are consumed by each activity, which translates into a cost. And now it is almost settled that the best method to control the cost of any entity is to focus on this activity, okay, and its associated cost. And this phenomenon or this principle led to a concept called activity based costing. Activity based costing, okay. And previously in the old syllabus, if you see, this ABC costing was a major topic for your CA final AMA, Advanced Management Accounting. But when the revision happened, what our institute did, they took this particular topic, ABC topic, and they put it under your intermediate topic. Okay, so in intermediate you are dealing with ABC, and once you come to the final, you are dealing with the application of ABC for cost management, and that is what is known as activity based management. So in activity based management, what you are doing is you are using the principles of activity based costing to manage cost. Is it clear? That is what is known as activity based management. Activity based management is nothing but application of ABC, activity based costing, to manage the cost of an entity. Okay, now there is one more item, activity based budgeting. What do you mean by activity based budgeting? When you say that your entire cost is driven by activities and your entire costs are managed by ABM, then your budgeting should also be in line with what? Your ABC. Am I right? When your main costs are driven by activities and any cost management technique is also driven by activity based costing, then even the budgeting, which forms the beginning, okay, which forms the starting of any costing technique, budgeting is the beginning. You budget first, then you execute your costing plan. Okay, so this budgeting should also be based on the activities, and such a budgeting process which revolves around the activities and its cost drivers is what is known as activity based budgeting. Is it clear? So this is nothing but making budgets based on activities, based on activities. Is it clear? So these are the synopsis of chapter 10. We are going to see these topics one by one. Okay, so you can write the first heading, strategic profitability analysis. Profitability analysis or strategic profitability analysis. Okay, what do you do in strategic profitability analysis? In strategic profit analysis, we analyze the operating income, OI, operating income, from various perspectives. From various perspectives. Okay, and if you tell me what do you mean by strategic profitability analysis? Meaning, okay, it is analysis of reasons for what? Analysis of reasons for difference in operating income. Difference in operating income, that is profitability analysis. You are analyzing the difference between operating incomes. But which all are these operating incomes which you compare? Okay, so operating incomes for previous year with the current year. Yes. You know what is the operating income for the previous year. You know what is the operating income for the current year. You compare these two. Why my operating income decreased this year vis-a-vis the previous year? Or why my operating income increased in the current year vis-a-vis the previous year? What are the reasons for it? That analysis is what is known as strategic profitability analysis. So in strategic profit analysis, we analyze the reasons for the difference in operating income of the previous year as compared to the operating income for the current year, or just reverse, difference in the operating income of the current year as compared to the operating income for the previous year. Okay, now how you do the analysis? Okay, so this analysis is done. How to do the analysis? The analysis is done from three perspectives, okay, or three components. What are these three perspectives or three components which constitutes a difference between the operating income of the current year and previous year? Three components. Component number one, change in prices. Change in prices. Price of what? Inputs and outputs. Do you think a change in the price of an input, will it affect the operating income? Yes, it will affect the operating income. Would you think a change in the price of an output, will it affect the operating income? Yes, definitely it will affect the operating income. So if the price of the input or output has changed for the current year in comparisons to the previous year, then do you think will it impact or will it make a change in the operating income of the current year and the previous year? Definitely yes. So one reason for a difference in the operating income of the current year and previous year is nothing but changes in prices of input as well as output. And change in prices of input is something which will affect what? Is something which will affect the cost. On the other hand, change in price of an output is something which will affect the revenue. So this component is something which affects both revenue as well as the cost. Is it clear? So change in price is one reason for difference in the operating income. Now, moving further, what is the next? Change in volume. Change in volume. Volume of what? Volume of output. Okay. Last year you sold 1 lakh units. This year you sold how much? 1,25,000 units. Okay, volume change, volume increased. Will it not affect your operating income? Yes, it will affect your operating income. How does it affect your operating income? This will affect the operating income again in two ways. Okay, one is change in cost. Am I right? Change in, I will say change in volume of inputs and change in volume of output. Whenever there is a change in the volume of the output, correspondingly what will happen to the volume of the input? There should be a change. Okay, so whenever there is a change in the volume of input, this is something which affects the cost, and change in volume of the output is something which costs the revenue. So again, the second component is change in volume is affecting both cost as well as revenue. Okay, now another one. I'm making it as change in productivity. Okay, what do you mean by change in productivity? Change in productivity refers to two things. Oh, sorry. Change in productivity is due to change in efficiency. Change in efficiency. Any change in efficiency, whether it is increase or decrease, it is going to affect what? It is going to affect the cost. Will it affect the revenue? No, revenue will not be affected, because revenue is dependent on two factors. One is the selling price and the other is sales volume. If there is any change in sales revenue, sales price, then the revenue will change. If there is a change in the sales volume, the revenue will change. If there is any change in the productivity due to change in efficiency, whether it is increase or decrease, it will affect only cost, no impact on the revenue. Are you following? Okay, so these three are the components which is affecting the operating income of 1 year vis-a-vis the operating income of the previous year. Okay, and you are analyzing the various reasons from each of these perspectives. Okay, right. Now going further, you can write in strategic profit analysis, strategic profitability analysis, an entity compare the operating income operating income of 1 year vis-a-vis the operating income of the previous year. Okay, this analysis is done from three perspectives which constitutes three components affecting the profitability. Next paragraph, affecting the profitability. Next paragraph, the three major components affecting the operating income are: 1, growth component. You can write difference in the volume of sales. Okay, here you can write this will affect the volume of both output as well as input, and the corresponding revenue and cost. Okay, then second one, price recovery component. Okay, this is difference in the prices of both prices of both input and output. Okay, this also will affect the revenue and cost of an entity. This is total or price recovery component. Then third component. What is third component? Productivity. Productivity component. What do you mean by productivity component? It is the difference in efficiency of inputs. Okay, efficiency of labor or machines. Okay, there are two factors which convert the input material to output. One is the labor or the machines. If there is any change in the efficiency of either of these factors, that is labor or the machines, the consequent effect will be there in the output. Naturally, what will happen to the cost? The cost may either increase or decrease. If the efficiency increases, then the cost reduces. Okay. If the efficiency decreases, the cost increases. Okay. This will affect only the cost of production or conversion, or cost of production or conversion. Is it clear? So it can have only a cost impact. Okay, now what you have to do, you will have to see what all are the formulas for these components one by one. Okay, so you can take the first component, that is growth component, in detail. Growth component in detail. Okay, now in growth component we are analyzing the variance between what? The number of units produced, number of units not produced, it is sold, number of units sold in the current period. Okay, vis-a-vis, we have already written this, in the previous year. Okay, now this growth component or this variance in the number of units can be due to two reasons. Okay, the number of units sold increases or decreases. There could be two reasons for it. One reason is due to increase in market size. Okay, then second is due to increase in market share. I will give you an example. Okay, ABC Limited is manufacturing what? Computer or laptops. Okay, now the market share of ABC is 30%. Now for the market size, what do you mean by market size? It is the size of the market which is measured in terms of the number of units sold in the market for a particular period. Okay, market size for 2019 is equal to 1 lakh. Okay, whereas the market size for 2020, it is 2 lakh. Venda. I will make it as 1,20,000. What's happening here? There is a company which is selling laptops, and this company has a market share of how much? 30%. So the market size of the company for 2019 was 1 lakh. So naturally, what would be the number of units sold? Will be 1 lakh into 30%, that is 30,000 units. Okay, last year you sold 30,000 units. Now this year what happened? Due to corona and lockdown and etc., the demand for these laptops increased drastically because everybody is going online. Okay, so the demand for the laptops increased from 1 lakh to 1,20,000, showing 20% increase. Okay, so naturally what will happen when the overall demand in the market increases? Naturally, a portion of that demand will be reflected, increase in the demand will be reflected in the number of units sold by every market player. Okay, so in case of ABC Limited, number of units sold should increase from 30,000 to 1,20,000 into 30, that is equal to 36,000. Earlier it was 30,000, now it has increased to 36,000. So due to increase in the market size, what happened? The number of units sold by ABC Limited also increased. Similarly, market share. Let us take the case of ABC Limited, same example. Okay, the market share of ABC, let us say it was 30%. Now during the current year, what happened? This was in 2019. In 2020, this share increased from 30 to 35%. Okay, there is 5% increase. So the demand or market size for 2019, it was 1 lakh. If the same market size continues in 2020 also, okay, what is the market share? 30, that is. Okay, if the same market share increases, continues in 2020 also, what will happen? 1 lakh into 35%, that is 35,000 units will be the number of units sold, which means there is an increase in the number of units sold by 5,000 units. So that point to be noted is the any change in the volume of any product could be due to two reasons. One is due to change in the market size, and two, due to change in the market share. And increase in market size is due to external factors, whereas due to increase in market share is due to internal factors. Here everything I explained based on increase. Same logic principles will be applicable when it decreases also. If the total turnover reduced from 1 lakh to 90,000, then you have to see why the total number of units sold decreased. Okay, is it there is any reduction in the market size, or is there any reduction in the market share? This could be the only reason why there could be a change in the number of units. Okay, so this is on the market growth component, market size and market share. Now going further, okay, I will give you a tabulation. Growth component, okay, could be due to two reasons: increase in number of units sold, decrease in number of units sold. Okay, increase in number of units sold, or it could be decrease in number of units sold. Increase in number of units sold, there could be two effects. One is the revenue effect, and there is cost effect. Okay, in revenue effect, this is nothing but increase in revenue, which is favorable. Next, cost effect. What will happen when the number of increase in number of goods? Increase in cost. Okay, here again there are two types of cost. One is variable cost, then fixed cost effect. Okay, variable cost effect or fixed cost effect. That is with respect to the growth component when there is increase in number of units sold. Similarly, when there is decrease in number of units sold, there could be revenue effect and cost effect. Okay, revenue effect will result in decrease in revenue, and in the case of cost effect, what would be the impact on the cost? This is decrease in cost, again on variable cost, and here fixed cost. So the decrease in cost may be on both this one. Okay, now going further, we will have to see what are the formulas for computing these effects. Okay, now with respect to these formulas, it is purely logical formulas only, nothing big or nothing complicated. But let me tell you, though there are no problems from using these formulas in your study materials, there is hardly one or two problems. Okay, that is only simple application. But I want you all to learn these formulas and understand how it is to be computed logically. Because sometimes for the exams, you may get some straight questions for 4 marks or 6 marks, where you just need to apply these formulas and derive the answer. 4 or 6 marks will be yours. Okay, so learn these formulas. Okay, yeah. Now next is growth component formula. Okay, now what do you have to do? You have to compute both revenue effect as well as cost effect. Revenue effect of growth component, this is equal to actual units sold in current year minus actual units sold in previous year. That is increase in the number of units sold divided by selling price per unit in current year. This is nothing but increase in volume of sales. Increase in volume of sales. Okay, now next is, okay, so what is this revenue effect of growth component? You find out what is the increase or decrease in the number of units sold. You multiply with the selling price per unit of current year. Okay, that is enough. Okay, so always when you multiply with a component, it should be of that of current year, because the difference between that component will be considered in a different formula. Here, if you see the selling price per unit in current year is what is not taken, not relating to the previous year, because the difference between selling price per unit of current year and last year is already considered as a separate item. Okay, right. Next is variable cost effect of growth component. Okay, next is what you have to do. Actual units sold in the current year. So this is the input units required for producing output of current year in the previous year. What you are going to find is what happened to the volume of the outputs. Okay, here you have to be to the volume of the inputs. Here you have to be little bit careful, because here the formula is bit confusing. Okay, so what you are doing here is, I will write the formula and explain. Input units required for producing output of current year, output of current year in the previous year ratio. What ratio? Input output ratio. Okay, that means if the previous year you required 1 unit of a particular product, let us say example product P. Okay, this is the output. It will request material A and material B. For 1 unit of P, you require 1 unit of A, and 1 unit of B, 1 unit of B, you require 2 units of B. Okay, this is what is known as input output ratio, right? Okay, for each 1 unit of A, you get 1 unit of B, and for each 2 unit of B, you get 1 unit of B. Okay, now this is the input output ratio of previous year. Previous year. Okay, now what do you have to do? You have to find out what is the current year production. Current year production. And let us say current year production was 10,000 units of P. Okay, and how much quantities of material A and material B was required or ought to have consumed to produce how much production? 10,000 units of P. 10,000 units of P is the current year production. In what? In as per the output or in input output ratio of previous year, that is for material A1 and material B2. Is it clear? Current year input output ratio could be different. Okay, that is what we are going to consider next. So input required for producing output of current year in the previous year ratio. In the previous year input output ratio. Minus what? Actual units of inputs consumed in current year. So for what? For current year production. So the first part was the standard with respect to the previous year input output ratio for the current year production. The second leg was the actual inputs for the current year production. Okay, so this multiplied by what? Multiplied by price per unit. Price or cost per unit of input in current year. Okay, so first what you do, you find out the output for the current year, then you find out the input output ratio for the previous year, then you find out the standard quantities of inputs that were required for producing the current year output in the previous year. You compute that. Then what you have to do, you reduce that standard data from the actual data for the current year, that is the actual number of units of inputs consumed in the current year. Then you multiply it with the cost per unit of input in the current year. Okay, this is the variable cost effect. Now, next formula, going further, you have fixed cost effect, not impact. Growth component. Okay, what is this? This is the fixed cost effect, because the cost, the change in the production or change in the volume will affect both fixed cost as well as variable cost. Variable cost we have computed easily. Now coming to fixed cost. Now any computation of fixed cost depends upon two factors. Factor number one, whether sufficient spare capacity is available in the current year to accommodate the variance in the production. That means the volume increase from 1 lakh to 1,20,000. Okay, so 20,000 increase in the volume compared to the previous year. Now, when you analyze the impact of such an increase on the fixed cost, you will have to see whether that increase has resulted in a capacity addition, or was there any surplus capacity available with the company to accommodate that increase in the the volume. Okay, so you can write that. I will give you a dictation on that. Not whenever there is increase in the sales volume, it will affect both variable cost and fixed cost also. However, the impact on fixed cost depends on whether there is surplus capacity to accommodate the increase in volume. Okay, so there are two situation. Situation one, there is sufficient capacity, sufficient spare capacity. I will use the term spare capacity to accommodate increase in volume. This is one scenario, one situation. Then there is situation two. There is no sufficient spare capacity. Okay, when there is no sufficient spare capacity, what would have happened? Capacity should be increased. by incurring additional fixed cost. Yes, by incurring additional fixed cost. That is the situation number 2. So any change in the volume will affect the fixed cost, but that effect on the fixed cost depends upon two scenarios. Scenario 1 or situation 1, there is sufficient spare capacity to accommodate the increase in volume. If the increase in volume is 20,000, whether that 20,000 could be accommodated in the existing capacity itself. So if it can be accommodated in the existing capacity, what is the advantage? There is no additional fixed cost to be incurred. Now situation 2, there is no spare capacity to accommodate an increase. Okay, so what you'll have to do, if you want to produce more, then your capacity should be increased. For increasing your capacity, you are going to incur additional fixed cost. Okay, these are the two situations. Now we will do one thing, we will break for lunch now, and after the lunch we will take these two situations in detail. Okay, so we will meet back at 2:30.